Yo, it's Friday, everybody. August 23rd. Yeah, Friday. So Jerome Powell gave the markets what they were looking for today, which was a dovish leaning on monetary policy. And we went up. And no surprise, I said yesterday it could be a throwaway day. And it certainly was, because the market recovered everything and then some from the decline yesterday. By the way, folks, I'm not going to forget this time. Please like and subscribe to this video. If you've done that already, thank you very much. I appreciate that. If you haven't, please do so, because it helps the channel. Somebody asked me, how come, Mike, you have advertising here? The only reason I have advertising here is because supposedly it helps the algorithm. And if you have advertising, then Google pushes it out there more. And it's just, believe me, I don't make anything, literally pennies. So I'm not in it for the money. I'm in it to try to, boost the viewership of the channel, and that's the only reason. I'd rather take away the advertising, but if it helps to boost the viewership, then I'm going to leave it in there. A bunch of things I want to go over. First of all, I really didn't listen to Powell's speech. I listened to a little snippet of it where he said, and this is the classic, the whole monetarism mantra that we've been hearing, that the Fed has been in a tightening mode now for 2 years. And this is extreme tightening. This is extreme tightening that we haven't seen in like 40 years. And my question is this, like this year alone, and we're not even done with the fiscal year, there's been 1 trillion plus in interest income transfers. When you look at interest on Treasury securities and then the interest that the Fed is paying to the banks, 1 trillion plus in interest income transfers into the economy. How is that a tightening? The economy is growing at barely 2%. Can you imagine, and I said this yesterday, can you imagine if that 1 trillion wasn't pumped in? I mean, it's just like, to call that a tightening is just like ludicrous. You're in mythology. You're in some kind of a cult which views things, right is left, up is down, black is white, that kind of thing, all right? And now the Fed is about to embark on a rate cutting regime, which is going to take away some or eventually all of that 1 trillion injection of interest income transfers into the economy. And that's considered an easing of monetary conditions. I mean, come on, folks, this is ridiculous. This is ridiculous. You had 1 trillion so far just this year. That doesn't even account for the fact that they've been doing this for 2 years. 1 trillion this year of interest income transfers into the economy. The economy is barely growing at 2%. That's another thing I want to say. He said economic growth is solid. Is a 1.9 or a 2.0% economic growth rate solid? I mean, come on. I mean, the amount of obfuscation and twisting of the narrative and kind of like, reframing everything that goes on here to support the monetarist line of thinking is just mind-boggling to me. It's just mind-boggling to me. Okay, having said that, I will admit right now that we could have an additional very big rally on top of what we have already seen. I'm not calling it yet, but I mean, the degree to which people want to buy this market based on the interest rate cuts that are coming. I mean, it seems to me like we need to see the actual impact of the rate cuts and their removal of that interest income before we have, because, and I'm saying this, and I can't even fathom that I'm saying this, because economic growth is not strong at all. It's weak. All the signs that we have been seeing point to weaker economic growth. Me personally, if you ask me, am I going to buy the stock market right now? Am I going to double up or triple up for the last leg? I can't do that. I don't do that, all right? I stick with the macro picture. Right now, it's telling me economic growth is slowing. I've been explaining or telling you guys that the market will follow the economy. We're in an emotional or mental state right now where people are hearing about, or investors are hearing about, the cuts in interest rates or that are going to be forthcoming, and they're finally deciding they want to get into stocks after the last 2 years that we've had this tremendous historic rally. I mean, I cannot be coerced or enticed into getting into this. It doesn't mean I'm selling. I'm basically long stocks in my portfolio, but I've been raising cash as the market goes up. And that's what I've been advising here on this channel. But I mean, to me, it just seems like there's a cohort of investors right now who've been sitting on the sidelines for the last 2.5 years. And now they're hearing that interest rates are going to get cut and they're jumping in. I've been talking a lot about the quality of investment, and this speaks to that. I think the quality of investor right now is very low, at least on the buy side. I would say the quality of investor on the sell side, look at Warren Buffett. I spoke about that recently. He's been liquidating. He's been raising cash. He's got an enormous cash hoard right now, and that hasn't come recently. Like, he's been doing that, I think, over the last year. Okay, it's like, I think he has a record cash hoard, and I often bring him up as an example of a guy, and I say, look, the closest hedge fund guy, which is the Citadel guy. Sometimes I forget his name. I forget his name already now. Who's basically, his whole operation is front running. He buys the orders from Schwab and TD Ameritrade and all these companies. He's got his servers positioned there at the New York Stock Exchange and the CME data center in Illinois. And he just front runs the orders, and his firm Citadel has made him a very, very, very wealthy man. But the gap between him and Warren Buffett is enormous. Maybe he'll get there. Like, he's a lot younger than Warren Buffett. I think he might be in his 50s, where Warren Buffett's like 90 something, I think. But the fact of the matter remains that the value investor, the guy who has the big picture, the macro, they win in the long term. This is it's not a sprint, to use this expression. It's not a sprint. It's a long distance run, however that expression goes, I forget. But I think if you examine the investor coming into the market right now, who just woke up basically and said, oh, they're cutting interest rates, I better buy stocks. Let me tell you something. Right now, after today's speech by Powell, the futures markets are pricing in a full 2 percentage point decrease in the policy rate, in the Fed funds rate. That would bring the Fed funds rate down to 3.5%. A 2% reduction, if you extrapolate that out over, the amount of government securities out there, that equates to a 700 billion removal of interest income. 700 billion removal, not immediately, but over time. 700 billion. So, like I just explained to you, we had a 1 trillion addition of interest income, and the economy is barely growing at 2%. What do you think is going to happen when they remove 700 billion on that 2% eventual rate reduction? I don't think it takes a genius to figure that out. We're going to be in a deep, deep recession. And that is not an environment for stocks. I'm sorry. Anyway, that's it for today, folks. It's Friday. Go enjoy. Have a nice weekend. And I'll talk to you. I'll see you guys on Monday. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Have a great weekend. Bye.